bond market. We talked about the stock market. There's another investment tool out there called a bond. A lot of times the stock market and the bond market, they're almost the opposite of each other. It's almost like a teeter-totter. Stocks go up, the value of bonds go down. When the economy gets in trouble, stocks go down, bonds go up. So they go back and forth, almost depending upon how the economy is doing. And by the way, there is no predictor out there that really tells us as to when stocks go up, what you invest in. By the way, if I were investing in stock, and I was making a huge amount of money, whoever makes a lot of money, they probably don't teach. They probably sit down and they make a lot of money and enjoy their Bentley, and they park next to the Rolls Royce in their huge mansion in Bel Air in the process. So that being said, a lot of people that write the books, I'm always kind of skeptical. If you're so good in selling stock and buying stock and buying bonds, why are you writing the book? You already have a lot of money. That's all. It's just my cynicism coming out. But the bond market is the safer market than the stock market. Usually, most people believe that in the process. So a bond is nothing more than you're loaning money to a firm. Okay, sometimes you're actually loaning money to the federal government or the local city or the local county. But regardless, a bond is a loaning of money with a promise for repayment at a certain percentage when it comes down to it. The principal, in other words, the face on the, let's say, for instance, you buy a $10,000 bond. It says $10,000, but sometimes you're not going to pay $10,000 for it. Let's say, for instance, that you have a municipal bond that's 4% and it pays 4% interest out there. So you're out there, you buy this municipal bond, and lo and behold, it's huge. 4% is huge in the market, and it's really safe. Typically, there's only 3 times that I've heard cities in California going belly up in the process, but eventually they repaid their debts because somebody came and bailed them out. Buying a bond from a municipality or the federal government, the federal government is not going to go belly up. If it does, there won't be any government at all in the process. So they're going to pay their debt no matter what happens. It's always safe. So if you get a decent interest rate off a bond that's guaranteed, no matter what happens, you may end up not paying $10,000. It's possible to pay $11,000, and you pay a premium over the value of the bond. Or it could be that you're buying a bond from Joe and Schmo's air conditioning company, and the two of them are out there hawking these bonds, and they're what we call a low-rated bond or a junk bond, and it says $10,000 in the face value, and you pick it up for $5,000 because everybody's afraid that Joe and Schmo are going to go belly up in the process. Okay, so sometimes you get a discount. Sometimes you buy a bond on a premium because it's so valuable, or sometimes you get it at a discount because everybody's concerned about the high risk involved with it. So it changes in the process as to what is being sold for in the market. Bonds all have a maturity date. Typically, we're talking long-term. So normally a maturity date is 5 years out, but everybody's got different variations out there. Sometimes you buy a bond in the secondary market, not from the company, but you buy it online. So it was issued in 2008, and it's a 30-year bond. So it's going to mature in 2038, and you buy it this year. So of course, it's already out there, and it's in the secondary market. So the company doesn't benefit from it because you bought it off the open market. Here's a series of government things you'll see out there. You'll see the T-bills, we call a treasury bill, and the treasury note and the bonds. They sell them typically every Tuesday in the actual bond market out there. When you're out there, you'll see municipal bonds, Yankee bonds included. You'll also see a lot of private sector bonds. And keep in mind, the price of the bond really depends on the risk of the company or the federal government in the process, and also the interest rate as you go through. The interest rate is on the face of the bond, and it's going to have, sometimes we call the interest rate a coupon rate, because in the old days, you got the bond and you got a sheet of paper with little coupons over there, and people talk about clipping out the coupons and sending them in. So Grandma's got a huge investment. Grandma's only worth $10.2 million, but she sit down there, and every Tuesday she sit down again in a rocking chair and go back and forth, and she would clip those coupons and she'd send them in and get a nice big fat check the next week. Grandma was a smart investor. Good night. Hopefully we can all be like her. But that being said, we called them clipping coupons. So we call it the coupon rate or the interest rate you go through. There's bond rating systems out there. Really, there's 3 big ones. There's a couple other ones as well, but you'll see they all have a pattern. triple A, double A, single A. Triple A is not about the car insurance company. They don't do any bond ratings in the process. But that being said, it's a standard quote of triple A, double A, and then B, and then double B. And when you start hitting that B all by itself, that's called very speculative. The triple A is the highest rated. So those are safe bonds. When something is triple A rated, number one, everybody feels comfortable in buying it. So if you buy it, there's less risk in the process of that organization going belly up. And then as you drop down, as you go lower, you start seeing it becomes more speculative or risky in the process. When you hit that single B level, from B on down, we call those junk bonds because they're just junk. Then who knows what's going to happen to them? But the rate is pretty high. They're speculative. In other words, they really have the potential of actually going belly up in the process. But man, they pay a lot of money. And if you're successful, if the company survives, life is good. In the process, I've been involved in bond ratings, primarily in higher education for different institutions. But when you look at it, the most that I've ever been able to achieve is the double A level. I never hit the triple A, but still double A is a phenomenal investment. And when you start having these high ratings, you can actually pay out less interest, or your bond sells on the initial market for a premium because it's a high quality bond in the process. So pay attention to the rating system. It's a big deal, and it gives you a hint as to what the different companies, Moody's, Standard & Poor's, and Fitch, how much they rated the bond and the quality of it in the process. Advantage issuing bonds, okay, bond holders are creditors, not owners. You can sit down and pay off the bond, and those people don't bother you. They don't get the vote either. The interest rate is tax deductible, and it's a temporary source of funding. But you have to repay it in the process. The disadvantage, it increases your debt, and then also has the market perception differs on the company, because you're looking on the term of your leverage level will go up because you have more bonds out there in the company in the process. So there's different classes of bond. There's a secured bond that's backed by collateral. So in other words, they sell bond to build a new facility. You also have unsecured bonds. They're not backed by anything, just by the good faith of the company. We call these, they're unsecured bonds, but the official term we call them, they're called debenture bonds. So secured, they're backed by land or equipment or a building. Unsecured bonds are debenture bonds. They're not backed by any specific collateral. To pay back the bonds, you'll see references in the financial documents to a sinking fund. It's got nothing to do with the ship sinking in the harbor. It really is, you're putting money in and you're sinking the money back in to repay the debt on the bonds. So you have that as well. And you have a couple other bonds to some extent. Remember what I said is that preferred stock is similar to borrowing money. You have callable bonds, which preferred stock usually has a callable provision, and that allows the company that sold the bonds to call them back. I know it says 2038, but we're going to pay you off this year because of the fact we're doing really good money, and we want to sit down there and reduce our leverage or reduce our debt in the company to sit down and sell another IPO. Okay, a convertible bond that allows them to convert the bonds into common shares of stock. Sure sounds like preferred stock, doesn't it? So a sinking fund is a reserve that you have. So know what secured and unsecured bonds are. A debenture bond, another word for unsecured, bond ratings, the maturity rate, and a sinking fund. Take care.